Subramaniam joins us now. Let's take our conversation forward with him. Sunil, fantastic to have you back. Thank you for joining us.
Thank you.
First half has been a rewarding one, Sunil, for investors, be it small cap investors or large cap investors. If you kept your faith, if you ignored what was happening on the medical front, if you just simply said, look, I'm going to be a believer in this economy, you've made good returns. Second half, will it be a draw, or the second half will also belong to the bulls?
It depends on the third wave, Nikunj. Honestly speaking, the market has discounted the second wave. And as you said, the belief that it's a short-term impact and India will pass that has led to FPIs and domestic MFs to consistently buy. That's the reason you're seeing the highs in the market. Now, in the second half, so what is the overhang on the market? Overhang is of the US economy's recovery, leading to higher inflation, stronger dollar, higher interest rates, all of which will have an effect on liquidity and could impact our markets. But to counter that is that if the vaccination story in India picks up dramatically, it's already started doing that, the monsoon story continues good, then domestic demand around the festival season, which is upon us very shortly, will pick up. Market will discount that. So I would expect that counterplay to offset. So very fascinating period for the market for the second half. If there is, however, bad news in the economy, like our inflation rising and RBI making noises about now going beyond their accommodative stance to now looking at inflation, those are the things that to watch out for. But subject to RBI continuing the liquidity support as well as the accommodative stance and domestic demand picking up and a third wave reasonably under control, there should be a huge pent-up demand as the unlock now comes into play. So fascinating time, because data from international is not something we can control. What happens will affect the markets. But if there is domestic revival on the anvil, then I would say that markets can touch new highs. So it's the timing of these issues, Nikunj, more importantly, because obviously, even if there's a third wave impact, it's again going to be for a short while because the confidence that India will overcome it is there. So longer term for the investors, it's a very good time to keep buying. But shorter term, I would say, look, they say look east, look west. I would say look overseas, whether it's east or west. It's that data which is going to determine the fate of the Indian markets over the next 6 to 12 months.
If there is no third wave, and let's hope and pray that there is no third wave, then what happens to markets?
See, the key is like this, Nikunj, that is definitely the domestic MFs, domestic investors have already started coming back to MFs. So domestic MFs are sitting on money. New fund office are raising money. SIP inflows continue to be strong. So domestic MFs are going to be buyers, but they're going to be buyers across broad market. Whereas the international news, right, will affect largely the large caps and the larger mid caps and the safety oriented place, right, which is where FIs tend to put their money. So when you say if there is no third wave, I would say a broader economy revival. And I would say that the growth of the BSE 500, BSE mid cap index would far outstrip that of the large cap. So if there is no third wave, bet on India, bet big on India and go down the cap curve.
Sure. Sunil, just wondering in terms of sectors, where are the newer opportunities and avenues? You've got 11 IPOs which are going to hit the street this month alone, and large size ones like Zomato. You think this is going to sort of re-rate the entire, it's a very limited listed pool, but do you think that valuations are not going to be a benchmark here, because I'm guessing just everyone would want a piece of the Zomato IPO?
No, it's very similar stories with other ones. So I would say it's these services, the fintechs, the financial services play of those where the private equity has participated, and private equity sees it as a very good time to cash out what their early stage investing was involved in. So I would say that this is what is going to mean is that there's going to be a healthy supply of IPOs of stocks to the market. There's going to be enough investor interest. But how many of these IPOs in, let's say, 3 months, 6 months are going to make it into the various indices, right? is the question. So I would argue that this is a brilliant time to actually give money to mutual funds, because I see this is a brilliant opportunity for the return of alpha, because stocks outside the index are probably going to appreciate, have much more investor interest than stocks in the index itself. These stocks will make it way, but it will take time to come up to the index, right? So I would say that the broader play, right, with all of these IPOs happening, there's enough interest for the IPOs to be all reasonable successes. So I would say the second is that the kind of companies which are coming, as you pointed out, right, the name of Zomato or whatever, PhonePe or whoever comes in, these are all futuristic companies. So they're not going to be your traditional valuation models. They are the Amazons of India, right? So if you look at the way Amazon traded in the US, right, it has nothing to do with their P&L, nothing to do with their EPS, nothing to do with valuation as we traditionally know it. It's about the growth potential, the PEG, as they say, and what rate of growth, multiplier growth they can achieve. So you can't take yes, the other stock which did was in the retail space, right? We all know the big stock that was there. So these valuations, so if you use traditional valuation models to look at it, you're going to go wrong. You've got to have different ways to look at it, see what potential investors are looking at, the big ticket ones, and then try and copy or mimic, or at least try to understand what they're doing, because that's where you will make your money. So it's a very interesting, like I said, it's a very fascinating time for the markets.
All right. Sunil, all right. So, it is an interesting time, of course, for the IPO market right now. And continuing to look at domestic revival, it's been the broader market, Sunil, at least in the last few months, that have really surprised us. So I don't even know whether to get into which theme, the cyclical versus defensive debate, because right now it just seems to be a plethora of opportunity out there. Out of the buckets that you've been tracking, where have you seen maximum traction building up that you feel is also sustainable going forward? Or do you think markets are right now getting increasingly stock specific, perhaps going for preferred plays, even if they will be mid caps, from each basket?
Well, it's partly, I agree with you. It depends on sector specific. Now, pharma, if you take, and metals, right? These two are essentially relating to immediate news, right? There's a lot of pharma news around the COVID and the vaccines and a drug ultimately to counter COVID. So pharma is benefiting from that kind of a news flow, and hence valuations and new offerings are coming in, which will be lapped up. Metals has been driven on the back of a China rally and an expectation of early revival of the US, right? So both these, I would say, in a sense, are at the negative end, in the sense that they are already discounting the future potential significantly. So they are prone to any bad news anywhere, the reaction happens. So I would say that it's a time to, I would say, book some profits in those sectors and remain. Now, where do I see that the rally which is happening has got a sustainability? I feel that IT, right, despite the rally that's happening in IT, I feel that the business model has got a fresh boost post-COVID. And any revival in the Western world is positive news for IT. And in addition, the strong dollar that I mentioned means a weak rupee, which is also supportive for IT. So IT is one story where I'm not worried about the rise in valuations. And I think a continued allocation to IT in the portfolio has to be there. The other sector where I believe that the future is really going to develop, because this US recovery, right? You may see this quarter, then next quarter, opposite story. You will have an iffy story for some time maybe, but the longer term trend, if you were to project it 18 months from now, I think you can reasonably bet that the US and the advanced world in general is going to be in a better position, would be on a growth path. So then it's not just IT which will benefit, but overall export-oriented sectors. You know, the PLI scheme on which the government has given a lot of thrust. So the PLI scheme means lots of foreign manufacturers, so lots of FDI coming in, which will give some kind of a support. What will that happen? The initial phase of the PLI will be a capex revival. So it's not the PLI sectors which I would focus on immediately, but the sectors which are going to help set up these PLI manufacturing plants. So again, we come down to our capital goods suppliers, building materials, cement, and all of those, because that order book will go up first. Those factories will get established. Then those PLI, and how many of those PLI are going to be listed in India is anybody's question. So the key here is that I would still back that cyclical infra build-up story, because all this FDI is going to spill over into that. I'll bear it in mind that the government's promised infra play this year may not happen because of the second wave came in and the cost onto the exchequer on that, but it's only a matter of time. The next year's budget will again refocus on capex. So I would still say that's a sustainable, where valuations are still reasonable, so that you can still buy with a 3 to 5 year time frame and leave enough money for all the investors to make, right? The other shorter term play, which the market is discounting, but I think there could be a positive surprise there, is consumer discretionary across the cap curve, because consumer staples is the safety play where FIs pay a lot, but consumer discretionary is more mid and small cap play, right? Your consumer durables, all of this, they had been expecting a good summer. The second wave came and damaged those hopes. But what's it's created this pent-up demand situation, which come Diwali, if the third wave, like Nikunj said, what if the third wave doesn't happen? If the third wave doesn't happen or third wave is under control, you could see a massive boom in the consumer discretionary demand because of the pent-up. And people's salaries at the middle end and the high end haven't got affected in the pandemic. It's only at the very low end that there has been some kind of a remuneration impact. So buying power is there. Some of it is coming into stocks through demat accounts. That's consumer surplus around the festival season could get deployed, in which case even your worries of imported inflation, easily those price increases your consumer durable manufacturers would be able to pass on to the customer. So I think that's an interesting play to watch for, because as we track the medical story, I think that's the key one, where the pent-up demand and broadly the services sector, your malls, multiplexes, hotels, travel, leisure, all of those, as the unlock happens, I think the market has been hesitant to really play that story, and only stock specific it has played. But a broader rally on the services play is also something that I think we can play with a reasonably medium-term outlook.
All right, so that gives you a roundabout view of really some of those pockets of opportunities. What about the kind of return expectation then, Sunil? And is that going to change year on year? Our retail investors are now increasingly optimistic about the picture going forward. If anything, the recovery is expected to come on track. We're seeing very positive global cues, and given what we saw last year, expectations are fairly buoyant.
Yes, retail investors are always one eye looking back, one eye looking forward. So they get comfort from what's just happened to project the forward. And that's where the way the market has handled the pandemic has given a lot of confidence to retail investors. And I expect retail investor flows to consistently increase and, more importantly, redemptions to come down. Now, return expectations, if you still look, last 1 year, 1.5 year returns have looked fabulous. But you project it back to 3 years, they're still reasonable. So I think that investors who have come in newly in the last 1.5 years may have unreasonable expectations of this, because that's not going to sustain, right? So what is the longer term expectation? I think that the markets have discounted the future. So the future has to happen, right? Now, as the future happens, you will normalize the returns. But then there is another future of the India GDP growth driven by capex story, which is still only being played by a few players, who are seeing the future. The still broader market participation into the longer term India story is still a story yet to happen fully. When that happens, you will see a rear-ended pickup. So I would say that if you say this year's GDP, you discount it in the sense that it is artificial. YOY last year was very low. So even if you get 9%, nominal will be 15%. Okay. But the next year, let's say we are looking at in India growing at, let's say between about 7% GDP growth. Inflation, if it heads around this 5 to 6%, which is the comfort level of RBI, you're talking about a 13% nominal GDP growth on a sustainable basis, bar this year. Now, that will mean that the stock market delivering 3 to 4% more. So I think a 16 to 18% band over the medium term for investors to expect, if they can anchor themselves to that with a broader market play, I think they will not be disappointed. But the key is that there will be volatility in the short term, and they have to have the patience and the staggered approach to counter this short-term volatility.
18% when Nifty is trading at a 30% premium to its historical averages. Some would say that, look, if I get it, I should feel like a king. I mean, is it possible from these levels, even if all the tucks fall in the line?
I think so, Nikunj, because what you're looking is long-term average. But you look at the 2007 peak, 2007-8 peak, when the markets were euphoric, right? So the point is that market goes through these waves. So the point is that if you will definitely see valuations come off, but they will rise again. I think so. The long-term average, it's a very misleading figure. It's like saying that the Ganga on an average is 5 foot in depth, so I can cross it. It's because there's Ganga is at 10 feet somewhere and there's a 2 feet somewhere that the average comes to 5. So the average usage is a slightly misleading number. So I would say that look at the previous peaks and look at whether the conditions supportive of a similar thing exist. Right? So what is the conditions now? There is liquidity support and there is a long-term buoyant outlook to India beyond the shorter term, right? So I think if you take those two factors, right, you think that earnings growth, right, which is being predicted by the market, right, can definitely happen. And the point is that 1 year from now or 2 years from now, the market will not worry about whether those earnings that we project today are happening, but will look at what is the 1 year forward PE 1 year from now. So as long as the India story remains undamaged from a medium term perspective, which I do believe it is, I think that the markets can sustain these levels, valuations, because the earnings will come up and make your valuations more reasonable. So I think that levels of the market can rise higher and higher. Good.
There are two ways of looking at this markets, Sunil. One, you look down and look back and say, okay, it's a 100% run up. It's a 150, 200% run up from the March low in individual stocks. The correction has to come in because that is natural for any bull market. The second way of looking at it is that, look, for those who've been waiting for correction are still waiting. So what is a better strategy?
I think the best strategy is to anchor it to why did you invest in the first place, right? Because everybody invests for some goals, right? You're just not just putting your money and just watching it grow like a money plant, right? So you have certain goals in your mind. My recommendation is that in the next 18 months, if you have some big long-term goals, you want to buy a book, you want to go on a cruise or whatever, you want to do that, book that profit and keep it aside in a short-term liquid or debt fund right now. Right? Don't bother about the fact that the markets could go higher, it could go lower. That's number one. Number two is a recent investor who came in, right? Who's seen all this joyride, right? So for that investor also, anchor your expectations. Now you don't need to book profits, but make sure that you don't feel disappointed with a strong double-digit growth that happens. So this is a mental game that you need to play. But the third thing is, if you are been there in the market 5 years, 10 years, or 1 year, but if your goals are, let's say, 5 years, 6 years, 7 years, 8 years away, then the two ways to play this, right? One is you just say, okay, I'm putting the money, I believe in India, forget about it. Don't get worried about the market in the 18 to 24 months, because that's where your fear of a tapering liquidity-driven correction can play out. But the other smart way to play that is to just stagger your investment through this process so that you're not committing all your capital right now and then subjecting yourselves to that sinusoidal, ECG tracker like of things. But if you stagger it, put your money in a liquid fund through an STP for the next 18 months, you have not put everything and not all at worry, but at the same time, all those corrections, which whenever they happen, you are there buying more. So I think that 18 to 24 months staggered approach for the longer term investor is, I think, the smart way to manage your emotions and ensure your long-term wealth creation.
Indeed. Just on the point, Sunil, on whether or not this broader market outperformance is going to stay. We've seen as to how year to date, the mid and small cap funds have given better returns as opposed to the ones which had a more large cap exposure. Do you think this strategy of a higher exposure to mid and small caps, of course, who can and are willing to take more risk in their portfolios, is a strategy that's going to work?
I think so. So the reason I say that is that what is the risk? Like Nico just pointed out, right? You have a 30 times forward Nifty well above long-term average. What is the reason for this? It's a strong FPI flows which has sustained. Where is the risk? It's about those FPI flows reversing either because of a strong dollar-driven US economy, US economy-driven, recovery-driven strong dollar, or the fact that money gets reallocated to commodity-rich markets because that US economic growth could fuel another commodity boom, right? So those risks are going to play out largely in the larger cap space, right? Now, the large cap is not only a safety-oriented place, right? There is a medium-term India growth story also in large caps. So why I'm saying this is that any sell-off there is enough liquidity in the domestic market to buy what? So there will be corrections in large caps, but I believe that domestic buying can step in. But domestic liquidity being what it is, right? Mid and small caps, because of this polarized way the market flows have come in, are still trading at about 15% forward PE discount to the large cap. So if you were to say that there is a valuation gap, now let's say there's a 5 to 7% correction in the valuation of large caps, but still another 5 to 7% valuation gap between mid and small caps and large caps. So then what is the ideal thing? So there is catch-up room in mid and small caps. But like you say, because of the volatility, the best strategy would be to choose a multi-cap strategy, multi-cap fund or a flexi-cap fund, which gives you, where the actual play, while we call them flexi-cap, multi-cap, it's actually the multi-sector play that's going to happen. So it's the right choice of sectors which are going to deliver returns in the future, whether it be large, mid or small. The thing is the concentration of sectors in the mid and small is more towards domestic economy and it's more towards the safety place in the larger cap. So choose a flexi-cap, flexi-sector approach, which most mutual funds which are in the multi-cap, flexi-cap space do that. A dynamic allocation across sectors, across the cap curve, it will be the best way to play this so that you get your due benefit. As you know, multi-cap funds SEBI has stipulated that minimum 50% should be in mid and small caps put together. So probably a good idea to choose multi-cap at this point in time.
Right. Okay, Sunil, great to have you on the show. We let you go on that note. Thanks for joining in as always.